Today we're going to be talking about at the money zero DTE. So we're going to look at strategies that trade at the money. A lot of people might consider these market neutral strategies, but they're really meant to collect premium as fast as you possibly can, given certain conditions. And we'll talk about what those conditions are in just a second. Now, when I'm saying at the money, and probably the one that you're most familiar with and most people are familiar with is the iron condor. The iron condor, and that's really, we're not going to talk about the iron condor because that is just a load of crap, to tell you the truth. Way too much risk for way too little profit. And the time it takes to get that profit, it's just crazy. But let's talk about things that have actual viability and whether or not we'd want to trade them over something that's not at the money. Now, probably the most, I would say the most popular one is something called the JOIF, or the Jim Olsen iron fly. And the iron fly, what is an iron fly, first of all? Well, it's a butterfly. Instead of being long, it's short, and that's because you have both a short call spread that's providing the bearish component of the fly, and a short put spread that's providing the bullish component of the fly, and they both share a short strike. The overall strategy is short. In other words, you can put it on for a credit. A lot of people think that really makes a difference when you put something on for a credit, as if having a credit is somehow better than putting it on for a debit, as if the trade is different somehow. All right, so that's one misconception that I like to clear up. There is no difference if I had put on a Jim Olsen iron fly or a Ernie Varatimus debit fly. They are exactly the same. They will behave the same. There is no difference, except for that the debit fly is far easier to enter and to exit. So why add all that complexity to your life by putting on a short fly? You'll think, well, then when I put on a short fly, all of that credit goes into my account. Right? So all of that money goes into your account, and you're saying, what? Oh, you're going to do what with that credit? You're going to spend it where? There's nothing you can do with that credit until you actually realize the trade. What I mean by that is by closing the trade. That credit is totally worthless to you. The only thing that credit might buy you is if you want to use all the money in your account to load up on strategies and take extraordinary risk. That it might do that for you, and for that reason, most brokers and others will fully encourage you to take that credit spread so that you can add more risk onto your plate because they don't give a damn. So anyways, there's no reason why you need to put on a credit spread or a credit butterfly. Put on a debit butterfly. It'll make your life a whole lot easier, and you can just deal with what you have. So the idea behind the JOIF, or the at the money butterfly, is that you're going to put this very, very wide fly right at the money. So those short strikes will go right at the money, right after the market opens. And you're hoping to collect a quick little bit of profit. And the source of that profit will be the, hopefully, the volatility crush that will happen, which will inflate the value of that butterfly very quickly, or accelerate the decay of the premium underneath. The reason why it will do this, and it won't always do it, but the reason why it should do it is if volatility, like it does, I would say 65, 70% of the time, goes through something called a volatility crush. So it'll come down in the very early parts of the trading day. Does it happen all the time? Absolutely not. Does it happen a lot of time? Yeah, it does. When is the best time that you're going to capture this, quote, volatility crush? Well, I would say about 60, 65% of the time it's going to happen right after the market opens, somewhere between 5 and 10 minutes, it will start its way down. Other times it waits a little bit later in the afternoon and doesn't happen until about 10:30. Sometimes, on some days, it will never happen. In fact, volatility will continue to increase, and you'll be sitting there with your hands in your pockets wondering when your butterfly is going to pay. In the meantime, price will move all over the place, and you'll probably get stopped out. So the reason why this happens is that butterflies are what we call vega negative. That means that when volatility goes negative or starts moving down, then the value of that fly starts moving up. But that's not a given. It's not a given at all. It doesn't always happen. I mean, it would be nice if we could figure out when volatility is going to crush, and when it isn't, then we could be more selective on these flies. But overall, you're going to be able to make something or get out with a very small loss. And, that can add to your overall profitability over the course of a year. So this is a trade in general that you're going to put on almost every day, because if it's happening the vast majority of the time and you can contain your losses and take advantage of those times when price or volatility does drop, you can make yourself about $100, $150, $200, at least according to the strategy that most people employ. And really the rules are something like this. You put on a 50 wide fly between, about 5 minutes after the market opens. Some people want to wait for 10 or 15 minutes. And when you get down to about $1.50 of realized or unrealized gain, you exit the position. Now, what are some of the caveats to this fly? Well, first of all, you have to take into consideration the risk that you're undertaking and what it would mean if you got an extremely sharp move at the open or after you enter that trade, more specifically after you enter that trade. Well, there's tremendous gamma risk in that trade. And what that means is if the market moves sharply, say 20, 25 points, you're going to experience an extreme loss unless you already have entered the trade with a limit order that will stem your losses. And that's no guarantee that you're going to capture the loss. But there's a good chance. There's a good chance that you put on that limit order and nothing will happen. Now, a lot of people talk about putting on orders prior to putting on the actual trade, or putting on protective orders prior to putting on the trade. You could do that. Of course, in order to protect yourself from any kind of whiplash, in other words, a price that goes down hits a stop order and then reverses the other way because you still have this other order on, you would have to put in something called an OCO, or an order cancels order, so that when the protective strategy or protective order executes, it will automatically cancel all your other trades. So that adds a fair amount of complexity to the trade. You could also sit there and simply manage it by eye and wait for it to happen and then exit your entire strategy as a form of protecting yourself. And that will work just fine. There are other types of strategies that you could put on depending on the size of your account, like a box trade. A box trade would be a way of nullifying the trade and locking in the profits and allowing both strategies to go all the way through to expiration. And that's an interesting way to go about it. So that way, if you have a smaller account, of course, if you have a smaller account, doing a box trade is going to be relatively difficult, because in this trade, the initial cost of getting into that trade is going to be, or the buying power that you're going to consume, it's going to be about $3,000-$4,000, depending on, well, anywhere from $2,000 to $4,000, depending on where we are in terms of the volatility regime. Currently, our volatility regime is extremely low. So that what that means is that the VIX is very low. So we're starting way down in the basement. And when you're doing that, when you start at that point, the butterfly, when you put it on, is already going to be preloaded with premium, or the value of the fly is going to already be mostly taken up. There won't be a lot of room to move. So that's kind of an interesting problem. In low volatility environments, generally you're going to like those, because when you get into the trade, the speed at which premium will decay tends to be a little bit faster, but there's not as much room to move. So these are all very interesting problems. The biggest problem I see with this trade is that you have extraordinary risk that you're taking on, and the risk to reward may not be anything that you want to take on. As an example, if you were to put on a trade today at about 9:35, you could put that on with about a $28 debit. So let's take a look at that trade and what that actually means. So if you're putting on a 50 wide fly, what does it mean to be on a 28-point debit, and what kind of risk are you taking on, and what can you expect, and how are you going to manage that fly? We'll look at other at the money strategies as well. Let's see. Let's take a look at some of the comments. How you doing, Andrew? Andrew says that insane day. Have a 30 wide 44.80, and it's a pin basically, but I took profit earlier. Both trades totaled a $310 debit. Got out early for $5.85, but now that upwards trend reversed and became almost a pin. That's cool. So what he's talking about by putting on a Batman, or putting on trades on either side of the market, which is another kind of at the money trade, but it's a market neutral trade. We have trades above and below the market. And looks like Adam had the same idea. I had a Batman earlier today, and when I closed the call fly near the top, bought back the short put strikes, rode the pit for $70 risk, and it returned over 700. So here he didn't. Adam didn't wait for price to come down, because it was near a pin on the call side. He was able to go to the put side, buy back the shorts for basically nothing, maybe 5 cents, leaving the long call or the long put exposed. And so when the market reversed, it came back and made money on that put. So he made money on the front end on the call, then made money on the back end on the put. So that's kind of like an interesting thing that can happen. It happens every once in a while, but that can certainly happen with our strategies. But that's outside of the scope of what we're going to talk about today. So that was the Batman trade, and I've talked about it a great deal. You can go back and look at lots of videos that I've mentioned the Batman. All right. I'm just going to go to the iPad and make sure that we can view. All right. So let's create a new. Now, when I'm talking about at the money trades, I'll set this up for you. This is what it's going to look like. We'll create a risk graph here. And then this is at the money. Whatever price it is this morning, I don't know what it was, 45.20, maybe 45.50, somewhere around there. But when you put on a butterfly, it'll look like this. A 50 wide butterfly. And then the real-time profit curve, it'll look something like this. All right. So this price of this fly will be the risk, or this cost, the debit, It'll be the width, which is 50 minus the debit. Now, on a trade like this morning, it was around $28. So that means that the potential here, from here to there, will be $22. So if you were to hold on to this trade, enter it here, and then hold on to it all day, and it entered right at the center strike, you would make $2,200. But, you know, that's a very low probability of something happening like that. So instead, what we want is we want to see some premium decay. We want this thing to go up a little bit like that. And of course, it has to stay in between these strikes. Actually, we would like it to stay in between these strikes, which are the break-even points. So there's break-even 1 and break-even 2. And so we're looking for price. We're looking for this difference in price right here. Let's draw that with a different color. And what most strategies look for is about $1.50 or $150. And that can happen somewhere between the first 5 minutes to 20 minutes that you're in the trade. Now, of course, you're assuming then that this range here is going to expand and that you'll have pretty good luck to stay inside of whatever that range ends up being. It's going to start out, you know, virtually nothing, about from here to here. And then as premium decays and grows into this guy here, you'll make this profit right there. Now you might think, well, man, what if it doesn't decay? And there are a few cases where it might not decay or might get delayed in decaying. And that is if implied volatility for the day, for the morning, remains high, or it starts low and then increases. That will, in some cases, even depress this profit curve and bring it down. And so you could experience a loss, even if you're sitting right in the middle. So that's a possibility. But the truth is that this ultimate thing that we're looking for happens about 65 to 70% of the time. Right? That's what we're looking for. We're looking for that small little profit. Now, most strategies like this are kind of adamant that you get out when you hit $1.50, because the risk of price moving back and forth or staying in the middle is relatively low. So once you hit that $1.50, you get out, you be happy, and you go on. Now, what you're doing, though, is you're looking to risk this $22, which is, I'm sorry, not that, the $28. You're looking to risk that $28, which is the debit, to make $1.50. That's an insane risk to reward. It's an insanely low risk to reward. It is a hugely risky trade. Now, a lot of people will claim that, well, I can mitigate that risk by being extremely diligent and adhering to these break-even points here and not allowing them to exceed maybe double that risk, or $3. And that's the goal. Now, is there any way to kind of guarantee that? Can you guard against quick markets at the open? Well, the only way to really guard against a very quick market at the open is if you have a pre-entered trade that will, or a limit order that will get you out should the market either drop or go up. So you have to really put on 2 additional orders, plus you'll want to also put on an OCO order, an order cancels order, to close the original trade or close the other order. So if one of these gets executed, then you want this one to close. You don't want it to be hanging around. You don't want to forget about it. Really, you want it out of there. So you need what's called an OCO order, or order cancels order. You can also manage this by eye or actively, and take your chances, but probably not a good idea. So that's the basis behind this type of trade. Now, what are some of the problems with that? Well, one is that about 30% of the time you're going to hit that max risk, or $300. So that leaves us with, well, what is the expectancy, long-term expectancy, if that happens? All right, so we can do that by looking at an options expectancy calculator. I'm going to just Google one right here, and we'll find one that we can fool around with. Kind of taking my chances that we'll find one here, but let's see. Yeah, I found one. All right. Tell you what, let's zoom in on this a little bit. It's at remec.canada, CA. All right, that's kind of cool. And let's go even further in on it. That's Safari. All right, so it's nice. There we go. All right, so let's plug in the numbers. Let's say that our probability of winning is 0.7. I think most people will agree that it's about 0.75%. And the average win is fixed at 150. And the loss is fixed at 300. All right. So that's saying that you trade this thing over 100 trades, and you can expect to make $3,750. Now, what happens if we get up to an 80%? Well, just by increasing our odds to 80% is a dramatic difference in terms of the amount that we can make. So you can see that this can vary widely. So let's just put, the range. Let's say it's between 0.7 and 0.8. Same win and loss characteristics. All right, so there's a huge disparity between there. I mean, at 70% win rate, you're only, after 100 trades, right? That's only $15 per, average of $15. You're going to return $1,500. But if you can increase that to 80% somehow, then you can return $6,000. That seems like quite a range. I'm not sure exactly how you would justify a trade like this, unless you're, and it's certainly not something that you can scale readily, because the risk in this trade is just monumental. You don't want to really fool around with this. If you have just one bad beat, it could wipe out the returns from 100 trades. So while this is an extremely popular strategy, I see, I don't know, to me, it's just way too risky. But if you have really tight controls and you can do all of this stuff and automate it, there's a good chance that you could get up in this range. Some people have said that they can get up as high as 85%. I'm doubting that, but that's what they say. So we have this huge range that you can make over 100 trades. 100 trades to make, at best, $8,000, more likely about $1,500, Or if you're in this 0.7 range and you happen to have a bad beat and you have a market that never hit your stop loss, you could potentially wipe it all out with just a single trade. So that's the JOIF, or the Jim Olsen Iron Fly. Now, I'm sure there are many people that are trading this that will say that are maybe have been trading it for a few months or even a couple of years that will disagree with this because they've had good luck up until now. But eventually, they're going to get bit. It's just a statistical certainty, an eventuality that they're going to get bit because the risk is too high. All right, we have some other questions here. Jim wants to know how to get his DTE hat, his 0 DTE hat. All right. Well, let's go to the more important stuff then. He's talking about this guy here. And I have another version here that also has the 0 DTE on the back. All right. I'm getting a whole bunch of these. So if you're interested in getting a 0 DTE hat, say that 10 times fast. 0 DTE hat. If you're interested in getting one, let me know, and I'll tell you how you can get one. It's actually going to be available to all members and anybody that passes our white belt certification course, which is super easy to pass. All you have to do is just take the course and pass it, which it won't let you get out until you do pass it, and then submit your trade log for the past 4 weeks or whatever your trial lasts. And then you get a hat, you get a certificate, and you also get the knowledge and the comfort knowing that you now are proficient in a strategy, at least in the basics of it, so that you can start doing quite well down the road. All right, so that's how you can get it, Jim. Let's see. Charles says, better off with 4 Delta strangles every hour until 2 p.m., 300% stop losses. Let the rest expire fully. And so how much are you going to collect on a 4 Delta strangle every hour? I'm gonna guess and say that you're not going to collect more than 35 cents, maybe. And sure, your win rate's going to be high, but you're also going to be hitting that stop, so that the stop that you're putting on, the 300% stop loss, is going to effectively take that 96% win rate and then reduce it down to about 75%. So while it sounds good, I don't think that it's going to be a great strategy. And it's stressful, yes. That's the problem. That's the biggest problem, is that almost all of your trades are going to move into an unrealized loss for a good portion of that trade, and you're going to be hoping that it moves back into your profit zone so that you can feel good about it, or take a smaller loss, or take the full size. I'm sorry, take a smaller loss, or take a small win, or potentially take the full size win, which will be very small. So that's going to be a problem. And Alan says, put a Batman on at 9:30. Oh, he's saying what he did. Close for a 50% loss at around 11. What did I miss? I don't know, man, because everybody else made money on the Batman today in 2 directions. You must have fallen asleep somewhere in between there, because we had a market that moved up very sharply and then moved down very sharply, hitting both sides of the Batman. Yeah, Charles, the beginning projected win rate of that strategy is around 90%. However, that's not what it will be when you add the stops and when you also add in your management of it. So it'll be considerably less. And this is an interesting name, AAAAAAAA. What's the rationale for not putting this on last 1.5 hours when premium decays quickly? Well, because it's decaying so quickly, the risk to reward equation multiplies almost exponentially, or it does exponentially. And so now the amount of credit that is left and the amount that you can actually hope to get versus the expected move is going to be diminishing dramatically near the end. Oh, then what you need is H's in there. IV crush in the morning, but gamma decay. See, if you get, and plus, if you get into the later part of the day, now, a drop like we had today, it will definitely affect this trade for that, what you're suggesting. And it will make it even more difficult to profit. But we've tried trading in the last hour, hour and a half, and it is extremely difficult. We've been successful with our out of the money fly, but an at the money with a completely inverted risk to reward, it is extremely difficult. It doesn't matter if you buy or sell. I explained that in the beginning. It's exactly the same. There is zero difference between buying a fly or selling a fly if it has the same strikes. It's exactly the same trade. There's zero difference. And there's really nothing you can say against that. I mean, that's what it is. It is the exact same trade. So if you're selling an iron fly or you're buying a debit fly, they are exactly the same. So why not put on the simpler, which is buying the debit fly? That's a rhetorical question. Of course, you would put on the debit fly because it's a lot simpler. You're going to have the same risk, the same profit potential, the same exact behavior of the strategy itself. And I know that's very hard for a lot of retail traders to understand that there is no difference between a debit fly and a credit fly, or a debit spread or a credit spread. They are exactly the same. So all these people that have been telling you that, oh man, you should put on credit spreads because you have this incredible advantage. Well, you have the exact same advantage with a debit spread, the exact one. Yeah, Andrew, I know. I have so many woulda, coulda trades that you can't imagine, because if I had called a trade this morning, as a matter of fact, and let's take a look at where it went. Let's take a look at this. And this is crazy. So here's today's trade. Now, in the beginning of the day, I did a couple of these JOIF type at the money flies, super wide. I was able to collect 50 cents from one of them and 65 cents from the other. So $1.10. And then I put on a 20 wide fly, and I got out of that trade right around before it actually got inside of the profit tent for about a $300 return. So had an okay day. Now, had I held on to it, I could have doubled my return. I could have returned about $600, maybe $700. But that would have assumed that I would have gotten out of the trade before we had this monumental crash. Right? So we had this complete reversal in the market, and it went way lower than the open. Now, a lot of people in the group had the Batman trade on, which means that they would have had two of these flies. something that looked like this. And if they did have this other trade on, they would very likely be in profit right now or near a pin. And so they would be making maximum profit on this, or about $1,800. So they would have made money on the first fly by taking that off. And then while they're in this fly, instead of taking the other one off, they just simply bought back the short strikes or did nothing. Either way, it would have worked. When price reversed down to here, they would have made tremendous money on this second fly. But I did neither of that. But I know that several people in the service did that. All right, the Rambo 911. What is your opinion about going out a couple of months and stacking a bunch of super wide butterflies and taking them to expiration? Well, I do that on things like Tesla and others. You know, they cost so little that it's almost like a no-brainer. You know, you put it around where you think it's going to go, and if any of them hit, or multiples of them will probably hit, you can reel in a lot of cash. But it's, you know, if it all goes the other way, then you can lose on all of them. So it's an okay strategy. Charles says, would matter more on SPY, where you can get assigned on anything. Well, you wouldn't want to do it on SPY. You'd want to do it on something where you can't get assigned, like the SPX, where you'd have cash settlement. Does it make sense to place a Batman every time, Ernie? No. I'm not a big fan of the Batman, to tell you the truth. And the reason is that today was an unusual day. Most days, we either go positive or we go negative. And if you were to look at the market and just tally up all the days and find out in every month how many of them went positive versus how many went negative, you'll find that in most months, there's about a 50-50 shot of it going positive or negative. It might go a little above or below in favor of one side or the other, just by a little bit, by just a couple of wins or losses, and that's it. But on average, it'll be about equal, going above and below, with a slight advantage to above. So then, from a plus-minus point of view, it really doesn't matter. It's going to be about 50% anyways. The difference is that on a trending market, the up moves on a bullish trending market are going to have longer bars, and so therefore it may take you deeper into your strategy and potentially make you more money. And conversely, if it's on a down market and you go bearish and you get half of those trades, the down bars will have a tendency to be much greater magnitude than the up bars, right? Even though there may be an equal number of ups and downs. So from that point of view, it doesn't really matter which way you go. Generally, I would say that go with the trend, and then go with all call flies in a bullish market and all put flies in a bearish market. And that will generally give you really good performance. Really, really good performance. And there's no stress. You know, you don't have to really guess. Now you might think, well, what if you don't know? What if it's a sideways market? And then you go for the Batman. In a sideways market, the moves aren't generally as large. And so a Batman is going to also have a number of trades that are going to end up right in the middle where you make no profit. And so your win rate is actually going to be lower. You would be much better off just guessing one way or the other, where you're going to potentially get it right. And if you have any kind of acumen in terms of reading the market, you know, maybe you can do a little bit better than 50%, maybe 55%. And if that's the case, you'll do well. Even if you do 45%, you'll still do okay. So while the Batman may seem like it has its advantages, to some extent it does, because it will allow you to get recover more of those losing trades, and they'll turn into winning trades. But overall, your win rate won't be that much better. Ernie, any way you can create a Batman bot trader? I'm sure there's a way. Why did it reverse? I don't know. Why is that important? What good would it have done if we knew why it reversed? And could we have known or been able to predict what would have happened if we knew what was going to happen that caused the reversal? All of those questions are unknowable, but I would say that for the most part, that's probably too little information, too late, and none of us would have been able to benefit from it. The Bert bot. Yeah, that's very funny. So, yeah, I don't know. I don't know what would be the best thing to do. But the market certainly is getting beat up today. And a lot of the news outlets are saying that's because of the employment report. I don't think so. I think that people are just taking profits, that the tech sector has been more or less overrun and kind of petering out. And now there's going to be some sort of rotation into another sector. So that's more likely what's happening. All right. So we went around and talked about why the JOIF type strategy probably isn't the best strategy from an expectancy point of view. Let's take a look at how that might compare to a zero DTE strategy or a zero dash DTE strategy, because you need the dash. If you don't have the dash, then it's trash. All right. So we'll take a look at what the expectancy of the zero DTE strategy would be. And so to do that, we need to go back to there. All right. So the average win rate on a zero DTE strategy is about 50%. I know, it doesn't sound like much. The average return, oh, what the hell's happening here? It's like it froze. Average win rate is about 50. The average return is, well, with a 5-figure account, it's about 300. And the average loss is about 150. It's actually, probably closer to 400 and 200. All right. So that's on a 5-figure account. For a 4-figure account, it's probably closer to, I don't know, 150 and let's say 80. All right. For a 5-figure, like I said, about 400 and 200 is, that's what my account is. All right. And so after 100 trades, you can make $10,000. Now, if you're looking at that JOIF one, which was at 70%, let's give it the benefit of the doubt and say 75%. And the average win is, the average isn't 150 because some of the wins are smaller. So I'm going to say the average win is 125. And the average loss is about 300. Yeah, that's a big difference. And then the other big difference is that the JOIF strategy is going to have tremendous, let's say we up this to 80%. All right, so now we're up to 4,000. The other problem, though, with this strategy is that you're going to exhibit and experience tremendous stress, where in the zero DTE strategy, there's virtually no stress. All right. Alan, you missed Robin. You had to add Robin along with your Batman. Yes. Yeah, we may be calling that the Robin strategy. Sure. anyways, the Batman's an okay strategy, but I would say that it is probably closer to a maybe a 45%. And I would say that the average win to loss is a little bit different. It's probably something closer to 380 and 180, right? Which still isn't bad, you know? It's an okay return. Again, very little stress. But compared to the regular 0 DTE strategy, yeah, I think that this is overall superior. Now this comports to what my results are in the past year, and if we were to take a look at that, we could see that. So win-loss 1.98, right? About 2 to 1. So I have here 367 and 185. Let's put that that into that calculator. And it was about a 46% return. And I don't know that that actually, does that work? Is that right? So after a year I had, after what, 318 trades. Okay, yeah, I guess that works out. So if we were to take those wins, this amount right here, this is only about 1/3 of a year. So if it were around 7,000 for 1/3, then it would be about 21,000 for a full year. And that's exactly what we have around here. Net profit of 21,755 right there. But, you know, here's the other part of that. A nice equity curve that just goes from bottom left to top right, and more importantly, a drawdown that never really exceeds 6%, really stays under 5.5%. That is the testament to its prowess and the ease at which you can trade this strategy with little risk and no panic, no, you know, going nuts. You're always in a calm demeanor. And then the other important thing is that the distribution of returns is indicating that this is an extremely scalable strategy, because you never have big losses, and you have a lot of offsetting wins that offset the losses, and then these big outlier wins. And so what that is saying is that you could increase your risk size a little bit, and then it would increase the potential profit dramatically. So it's a very scalable strategy as well, where the JOIF strategy is not scalable at all. It would be very difficult to increase the risk there to get any appreciable amount of extra profit. All right, so there you go. There's the whole story. And tomorrow, let's see, Monday, we'll take a look at some other strategies and how they compare. All right, that's all I got. Peace to you all. Time for music. Hope you all have a great weekend.